Hi everybody, hope you're doing well. Welcome back to the LAGFX channel and another Learn to Trade video that we're making. So in this episode I wanted to run over the real reason why greed is killing your win rate and killing your profits, and the reason that we have to understand what phase of a market cycle we are within, and even understand what a market cycle is in order to understand when is the best time to trade and what to expect during each phase. So if you are unfamiliar with what a Wyckoff Price Cycle is, I will flash an image on the screen now. I'm also going to try my best to explain. So we're understanding that within a regular market schematic or within regular market structure, there is going to be a theme that it follows. Now, there are four phases that we can see. That's either going to be a markup, an accumulation, a markdown, or a distribution. So those are our four phases that we can be within. Now, a markup and a markdown are obviously trending markets with a lot of volatility, and then distributions and accumulations, much more ranging markets with a lot of liquidity creation and manipulation. So if we draw this out, for example, we will accumulate, however that may look, and then after we accumulate, we will enter a markup phase. Once we enter an overbought state, that is when we start to create the distribution. And then once again, we come into a markdown, which will look something along the lines of this. Now, the thing is that this will still follow a mean direction. And what I mean by that is that here we will begin to accumulate once again. Like so. And then we will have another distribution, so on and so forth. But what we will see within this, in this sense, that mean direction is upwards. We can see that what's happening is following structural laws. The lows are being protected, the highs are being broken. Now, whenever we are taught market structure, we're typically just taught we have an uptrend, a downtrend, uptrend, downtrend, or impulse retrace, impulse retrace. Now, we'd never go into enough detail to understand exactly what's happening within this, because as we load into a market, this is how it looks, and it is no longer as straightforward as impulse retrace, so on and so forth. Now, we need to understand that these ranges right here, this is a distribution, this is a distribution. Now, we will change color for an accumulation, and then we obviously have our mark up and our mark down. So this is our mark up, another mark up, and then we also of course have our mark downs. Now we have to understand that each of these is a different phase within the market that we need to understand how to trade. So when we are within an accumulation, we are going to understand that the market is going to be range bound, and therefore what it's going to do is it's going to be constantly breaking upside and downside liquidity, giving us an unconfirmed bias. Now, if we throw on screen a schematic or a typical schematic for an accumulation, you see that within the accumulation alone, we have breaks of structure and displacements to both the up and the downside. There is no clear trend, there is no clear way of entering in on the market. Therefore, if we were not aware that an accumulation was being created, how would we know how to tackle it? Of course, there's going to be intermediary positions. Each time we come up or back down, there's going to be, fractal trends that we can try to get involved with. However, it is not going to be simple at all. Now, when we emerge from this accumulation and we come into a mark up, and we have clear confirmation because we have seen the accumulation get formed, and we are now seeing price have a lot of volatility to the upside, a lot of demand present in the market, we understand this is going to be much easier to trade because it is going to follow simple bullish structural laws where it's going to constantly break the highs and protect the lows. Now, within this markup, we may even see structure a little bit something like this, just more fractalized, where we have fractal accumulation, markup, fractal distribution, blah, 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 and we're able to get involved in these regions where we have the last bias to sell, price trades us in, we accumulate, we trade on. However, When we are in a markup and we are within a phase in the market where demand is just that dominant, what's typically going to happen is we're going to have these stepping stones. Now, each of these regions, especially the one right here, rather than giving us a nice full retracement to try and get involved with, all it is going to do is give us a reaccumulation in order to take price higher. And this is known as a stepping stone. So as we're emerging from this trend, the more and more demand that we enter or is introduced into the market, the less likely it is going to be that we have an impulse, a nice full retracement giving us a clear entry, whereas instead it's probably going to be something along the lines of an impulse, a bit of liquidity building, some manipulation, and then a continuation higher. Now, we're asking ourselves, how are we able to get involved with this? Because there is no clear pullbacks into, for example, a last sell to buy, which we were maybe watching for, and if we were getting deeper correction waves, maybe we would have been able to find the entry. However, we have to understand that because we are within this market phase, and through analyzing the supply and the demand balance, we can tell that demand is clearly in control, and we are seeing visibly it is unlikely that these correctional waves are coming into play. Therefore, we need to study when these reaccumulations appear to be forming, and even when people see the displacement and are starting to try and get involved on sell positions because they feel like, okay, the market is displaced, it is now confirmation for us to go short. We're ready to start trading into that correctional wave to see price pull all the way back down. No. We have done our analysis to a more thorough standard. We understand that we are within a Wyckoff price cycle. We understand this is quite simply a stepping stone or a reaccumulation in order to take price higher. And we see this not as a displacement, but as a liquidity grab and the formation of the spring. Now, this spring is likely going to come and tap us into a hidden demand zone that's going to be hiding within that structure that must be identified on a lower time frame. Now, there is examples of this, and I will show you examples of this a bit later on in the video, but just remember that where people are looking to go short, the price is actually trying to find a demand zone to go back long and then take off again in that direction. Now, if we are able, or we had already analyzed the price cycle, analyzed the supply and demand balance, and knew this was going to happen, we are now involved in this position here, and we see that if we are involved here, we have so much room to keep that long position going. So this is why it's so important to understand where we are within the scheme of a Wyckoff price cycle. Again, when we come up to a distribution, same thing is going to happen. We're going to be range bound. We're going to keep trying to get involved on all of these what seem to be displacements. Okay, we've got a displacement, let's try and go short. Next thing we know, price displaces to the upside. Okay, let's try and go long. Price then comes a bit down, it displaces us again to the downside, and only now is the trend in control and were we right. And out of all of these times inside of this, the bias is constantly going to flip, because the purpose of this range that it will sit inside of is simply to just build liquidity, manipulate it out of the market. And if we're trying to get involved in regions in the market where we are range bound, or we are accumulating or distributing, it's much less likely that we are going to be able to get involved in positions, because we are going to be manipulated out more often than not. If, however, we wait for these phases to start, so for a great example here, a distribution, as we enter phase E, that is when price leaves the trading range. We know that after phase E, that is typically when the mark down, or from an accumulation, a phase in an accumulation, the mark up. And when we see phase E get formed, we know, okay, this is when we can now start looking for positions, because we are within the mark up, we are within the mark down. The same thing with the mark down, as I've drawn out right here, with the purpose is we have a redistribution. So as stated, as we come to a mark down, we may not have impulse correction with a nice full pullback into a buy to sell candle before we go lower. Instead, like we were talking about with a reaccumulation, we're going to come down, build some liquidity, disconfirm the bias back and forth, and then continue lower with high volatility. Now, when we've had this displacement, some people are thinking, right, let's start going long. We've had the displacement, we can get involved in the correctional wave. But no, this is simply just a liquidity grab before we continue lower. Now, if we were unaware of the fact that this was happening, let's say we didn't understand that we were within this phase or a markdown of a Wyckoff price cycle, or we were unaware that there is just that much supply in the market that it is impossible for such a large correctional wave to be formed, we would be able to get involved in this. And if we were able to get involved with this, the profit potential is honestly endless. But I think that is enough theory work on this and on Wyckoff Price Cycle. So if you were unfamiliar with what a Wyckoff Price Cycle is, please, I just beg that you go online, search them up, understand what it means, because each one of these, as I try to color coordinate them, so we have 4 different phases in the market. We need to understand the best way to tackle each and every single phase, because each phase is going to give us a different market condition that is slightly different for our strategy, or has slightly more or less of an edge for our strategy. And therefore we need to understand, okay, well, which market phase is my strategy the most profitable within, and which ones is it least profitable within? Because there could be some phases where you completely lose your edge, in which case you should avoid ever trading within those phases. Even if that means going prolonged periods of time without placing a trade, so be it. But if on the flip side, I understand, okay, I am great at trading the range bounded areas, so an accumulation or a distribution, I will avoid or try to avoid taking any trades within the markups and markdowns, and just try to take trades when we are within a phase on whatever time frame or whatever fractal nature of the market we're looking at. I will only get involved when the market is range bound, like so. Or on the flip side, you may find that you are better trading a trending market, in which case start to only get involved in your markups and your markdowns. Okay, so I am here on the Great British Pound, the US dollar market. Now, as we can see, I just wanted to show a nice example here of what I was talking about, quite simply. So we have a distribution, a markdown, an accumulation, a markup, a distribution, a markdown, and then what we're seeing here is that this is actually a redistribution. So we are still within the markdown phase, but taking this back to a price cycle, what we're seeing is we've had the distribution happen, we have been range bound, we have constantly delivered displacements, A to the downside and also to the upside, but each time we deliver that displacement, we're not emerging from a big trend and we're not able to get involved on longer term positions. However, if we were to understand that this was a distribution forming, we'd wait for phase E, where we have the final displacement, like we've done right there. We have a test, and then when we get involved in sales, we have all this wiggle room to get involved in, rather than getting involved in the displacement here and literally just having that tiny movement of profit that we could potentially have caught. So this is where it becomes important that we understand when prices are within which phase and when they are emerging away. So as I said, we need to identify phase E within both an accumulation and a distribution, because that is when we want to start executing our longer term positions. Like stated here, out of all the displacements we had within this range, only one of them ended up being a profitable scenario. So if we were getting involved in every single one, only 1 out of potentially 4, 5, 6, however many displacements it may be, were actually profitable. But if we had the knowledge there and the experience to know that only this final one was phase E and was the correct displacement to get involved in, we would be able to mitigate any of the losses within there and only get involved with the correct ones. Same thing again in an accumulation. We can go on forever about this, it doesn't really matter, but you're starting to understand the fact that we follow price cycles, and as you can see here, we have broken the low and we are still continuing lower, so we can assume moving forward that we are going to be bearish, and therefore we can start to ask ourselves, well, eventually what's going to happen is this is either going to turn into an accumulation or another redistribution. But whenever we do decide to finally accumulate and then have that mark up, we know that because we're meant to be bearish, because the price cycle is telling us that we are moving bearish, that's when we start looking for our points of interest to sell from, so on and so forth. Now I just wanted to bring you over to the US dollar, to the Japanese yen market, because there is a prime example here. So from the 14th of April of this year all the way up to the 30th of May. So what is that, about a month and a half, 6 weeks? Throughout this entire time, we were within a ranging market. This is a reaccumulation, sorry. And as I was talking about in the examples, what's going to happen is we're going to be delivered with a displacement. And this even caught me out. And what we're thinking is, right, we've been delivered with the displacement. Now is the time to go short. The market's reversing. We're seeing a distribution. This is the best possible time for us to go short and capitalize on the new markdown phase that is going to emerge. we see that what's happened is, yes, we have displaced the market, but we've simply displaced it in order to mitigate a hidden demand zone to form the spring of the reaccumulation before then taking our next move higher. Now, so many people would have been taken out of the market given the fact that they thought, right, we've had the displacement, we'll take that same bias. And the reason this is tricky is because, as we see, all of these breaks of structure, if we get the brush tool out once again, we have a break of structure, we're then deciding, right, let's start going long. We then trade up, come back down, another break of structure, okay, let's start going long again. And then we have a high volume push back down. The displacement, we confirm that we are going bearish for some time. We do follow said bearish structure. It seems like we're going to continue that and that we have a new trend emerging. But as we said, we know that is simply just part of the stepping stone to then take price higher. If we now zoom out, we can see that this adds to our price cycle theory because we have an accumulation in the market within this region. We then have the markup phase emerging. And what's happening is within this market, longer term, we are still within a markup phase. So we have to understand how can we tackle this market. For people who have only just recently got into Forex, this may be so unfamiliar to you because for however many years it was within here, we were range bound, and that was a different phase for us to be able to tackle and execute positions within. You can see that because there's not as much volatility to each side, we are having better pullbacks, deeper mitigations, easier to find entries. But when we emerge out into a mark down or a mark up, this is where we're not seeing as many of these pullbacks. We're seeing the stepping stones, such as this reaccumulation we were just talking about, where it's not as easy to just find a simple impulsive wave up, a correctional wave to then mitigate something below. Rather, we're seeing these stepping stones that are trying to manipulate people out of the market, which becomes really, really difficult to trade. So this is where I'm trying to say that don't be greedy. Don't try and just trade the market in every phase at all times. Do your analysis, understand what phase you are within, then determine using practice or just logging your trades to understand, okay, well, which phases do I seem to profit the most from? Maybe it's just simply a mark up like we're within now that you are most profitable in. Maybe even a mark down you cannot seem to trade. If that is the case, then just wait for these long emerging markup trends. Now, that doesn't mean that we have to wait 6 years to place a trade, because we have to understand that all of these trends, what we're viewing now, accumulation, mark up, is happening on the more fractal time frames. More fractal again, you know, within this, as we stated, within these moves down, within this miniature trend that we saw just within this period, we had the same thing. We had a distribution, mark down, accumulation, mark up, distribution, mark down, accumulation, so on and so forth. Now, you have to identify which phases you prefer to trade, and then look to only try and trade those phases to be the most profitable. If we try to be greedy and just trade every single trend possible or every single phase, then we are potentially going to lose our edge longer term. Because let's say in one market condition we have a 70% win rate, but then in the one on the flip end we have a 40% win rate. This averages down to only a 55% win rate between the two. However, if we were to just avoid trading the one where we have a lower win rate, we're keeping our win rate to a 70% figure, and therefore longer term we are going to be more profitable. Now, I hope this video has made sense. There was a lot of information I tried to run through there. Sorry if it sounded quite rushed, but I don't like to prolong these videos out too much. I actually like to try and keep them short and sweet. But I hope you understand the importance of what I'm saying here, and that understanding Wyckoff price cycles is so crucial, and that understanding which phase of a Wyckoff price cycle we're within is also crucial, because A, we're either going to avoid it, or B, we're going to have to tailor our strategy to that phase and understand how we were profitable in the past within that phase. So once again, thank you everybody for watching. If you have any questions at all, make sure to leave them in the comments. If you want more information about things like this, make sure you get involved in our learning lounge. This is a free Telegram group chat where we just post a lot of information on this sort of stuff. If, however, you are quite new to the game and you want to actually take your trading to the next level and have either myself or Luke as your mentor, look out for the mentorship program, which is coming very, very soon. Look out for all the information we'll provide on that. Very excited to launch it, and I can't wait to share it with you all. But with that being said, thank you for watching, and we'll see you next time in a Learn to Trade video.